Well, if you get bored with the stock market, apparently all you have to do is just wait another day. Of course, another volatile session here, at least in the United States. Almost another 2% pullback. And we've had basically 4 days in a row with those nearly 2% moves here. And that's not typical, especially if you lived through 2017, where it was kind of a humdrum, uptrending market without a lot of volatility. So I would say this year is a little bit more normal when it comes to trading. But even still, we've had our fair share of volatility. So we're going to take a look at how that's being shaped up with the rest of the markets. NVIDIA was one of the stocks blamed for today's sell-off in the market, as it's kind of getting out of its self-driving car technology, or at least putting it on halt for a little bit. And then I wanted to highlight in our trade application today a stock that I found that was actually up today. I've been meaning to talk about it for a while here in these videos and kind of highlight something that a lot of investors might be overlooking. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's March 27th, 2018. I want to welcome everybody to the video here this evening, whether you're new or whether you're a longtime viewer of David and I's videos. Remember, you can always subscribe to our YouTube channel by clicking that red subscribe button. You can also click on the bell icon attached to it if you want to be notified whenever we do upload these videos. And in addition to that, if you have comments for us, feel free to scroll down, leave some comments. Also, give us a thumbs up if you appreciate these videos. Remember, David and I do track those thumbs up, and we want to make sure that our time is being well served. Obviously, it takes a few hours to put these together with the recordings and the editing and all different types of things like that. So if you're getting value out of these free videos, the only thing we ask out of you, give us a thumbs up, and that way we know we're still making an impact for you. In addition to that, we do have a description area that will give you some nice links, including a link to sign up for our email distribution list, which will allow you to see all the different stocks that are giving you bullish and bearish clusters within the S&P 500 on a daily basis. Now, in addition to YouTube, we're also heavy users of Twitter, which I saw his stock was down pretty significantly today. But on Twitter, my handle is @BrandonVanZee, all one word. Market Scholars handle is @market_scholars. And David Settle, who just passed 5,000 followers last night, thanks to all of you that followed him, he can be found @DavidSettle42. We would really appreciate it for those of you that do participate on Twitter. David and I generally try to pin the Market Outlook tweet to the top of our Twitter feed. You know, when he's doing it on Monday, Wednesday, Fridays, it'll be at the top of his. When I'm doing it on Tuesdays and Thursdays, it'll be at the top of my Twitter feed. So if you could do us a favor, just go over there, click like and retweet. If you get value out of this, that would really help us kind of enhance and expand our business. As you know, we're busy building a small business together. We really appreciate your guys' enthusiasm and loyalty there. In addition to Twitter, we're also on Facebook. Obviously, a few problems around Facebook lately. They've been in a little bit of hot water as an organization, but clearly it is kind of the globe's community in a way, or gathering grounds, and so it makes sense that we're going to have a presence on Facebook as well. So if you're on Facebook, feel free to join us at that web address that you see in front of you, which is a web address to our group on Facebook for these Market Outlook videos. All right, with that, let's go ahead and get into a little bit of analysis here on the markets today. Again, I'm going to highlight our heat map or market carpet, however you want to describe that. I did that last week on Thursday as well, because we had a big sell-off day, and it provides a nice visual of kind of what happened in the market here today. And you can see pretty ugly across the board. Everything except for this little area in the lower right-hand corner there is pretty much red. Now, one thing I have noticed about the Thinkorswim platform, for some reason, they're still not updating their real estate sector, which became a 11th sector of the stock market back in August of a couple years ago. So be aware, the real estate is not separated here with the rest of them, and real estate was up today, so that would have been maybe one more outlier to add with some of these more defensive areas. But the point I'm trying to drive home here is that your more robust cyclical types of sectors were really the ones that suffered the most. I mentioned NVIDIA in the intro here today, and as I hover my mouse over NVIDIA, and remember, NVIDIA has been one of the best stocks in the entire S&P 500 for the last 3 or 4 years. I mean, phenomenal success, doubling, tripling, the type of performance you could only dream of. Well, starting to get back a little bit all of a sudden, and again, the news today was that they were starting to halt some of the areas of their driverless car technology, which a lot of people thought was going to be a big growth market for them in the future, and it very well may be. You know, sometimes companies just need to reshuffle the deck or pause for a little bit, rethink things, and so they may not be down and out. But that was certainly one of the difficulties upon its share price here today, which then bled over to a lot of other areas within technology itself. And so with that, and maybe since I'm over here on the Market Watch tab right now, I'm on the visualize area of Market Watch. I'm going to now click on quotes over here to the left, and I'll show you just briefly. We'll get into this a little bit more as well when we get into our sector 12 grid. But again, look at the performance of all the various sectors here today. You had utilities up at the top. Utilities were actually up today, 1.43%. That's an outsized day. That's not just a normal day where it's up. I mean, the utilities typically don't move more than 1% to the upside. So you can see money transitioning, again, a little bit more of a risk-off type of a day where, you know, money that was chasing the cyclical areas is now drifting back over to some of those defensive areas. And you can see, like I mentioned before, too, here I can track the real estate sector because this is my own personal watch list here. You can see XLRE, which tracks the real estate companies within the S&P 500. It was up slightly today, 0.16%, followed by Staples, another one of those defensive areas, and that's where our trade application idea will come from a little bit later on today. Let's now take a dive into the charts a little bit here, and you can see I've got the S&P 500 here pulled up. It's down 1.73 today. At its worst levels, it was down 2%. So at least we did get a little bit of a rally there to kind of save the day. But again, the story, at least in the last 4 days, the last week, has been really dramatic price movement. You remember that 2017, I don't even know if we had 4 total days the whole year when we had 2% movements. And here we've almost had them 4 days in a row. Not quite, but in the neighborhood. And so, yes, we've had some very volatile days here. Volatility's ratcheting up, starting to feel maybe a little uncomfortable for some of you, depending on how long you've been in the market. If you just started in the last year or so, then yes, certainly you have every right to feel a little uncomfortable here. But a lot of you guys that are old hands to the market know that this isn't necessarily unheard of type of price action here when we get 2% down days. So we learn to stomach the moves, and for some of you will look at it as opportunity. Remember, when markets get really volatile, there are subsets of industry or of traders out there and strategies out there, swing traders, day traders, that actually prefer the volatility. I know that may not always be the case for those of you that are long-term investors, but keep that in the back of your mind as well. There's probably room in somebody's portfolio for a variety of different strategies that are out there. But where we stand right now after today's pullback is, first of all, we had a bearish engulfing candle, generally a bearish candlestick pattern, if you didn't know so already just by the simple 1.73% pullback. But in addition to that, completely basically taking away yesterday's gain. That's what that body is telling us right there in that candle. So today's body completely engulfed yesterday's body. Notice that our posture using the market forecast intermediate term line, which is how we set our posture here in these market outlook videos, continues to be bearish. Even after yesterday's big move, we still did not move back to bullish. So for those of you that have kind of been persistent about continuing that bearish posture, you're probably happy about that, at least as of today. Now, tomorrow could be a different story, right? With how volatile things have gone, you never know. Maybe we're up another 2% tomorrow. But for right now, for those of you that are trying to establish your posture, one of the ways that we do that is by looking at that green line on that market forecast. And one way to identify that when I've got this particular chart pulled up in these market outlook videos is if the chart background color is pink, that means we've got a bearish posture, and that is certainly what we have right now. Let's go ahead and take a look at our next chart setup, and this is where we're going to look at all 4 major U.S. indices here. And you can see that all 4 of these charts are all pink as well, meaning all four of these different charts, or indices in this case, are all considered to be bearish at this moment in time. Now, just because the posture is bearish doesn't necessarily mean that we're destined for some sort of a bear market. Obviously, at some point, we will have a bear market again. It's been 9 years. But just because our posture from the intermediate term perspective is bearish doesn't mean that we assume that starting right now that we're going to go into a bear market. Remember, a couple of things that at least I'm looking for, and I know I've mentioned this to David as well, and he's looking for these types of things. Typically, before we go into some sort of major bear market, we get an inverted yield curve. Inverted yield curve. We have not seen that yet. So that's one mark against the prospect of us starting a bear market right now. Another prospect or mark against the prospect of a bear market right now would be that a lot of times we have significant outperformance of a handful of sectors within the business cycle or the economic cycle or the stock market cycle. And those areas that do the best near the ends of those big stock market rallies are typically materials and energy stocks. Now, who knows? Maybe this time is different, right? Those are the four most dangerous words in the stock market. But we do know that energy has changed pretty dramatically over the last couple of decades with all the additional shale finds that we've had here in the United States. That's really kind of changed the supply-demand equilibrium. But generally speaking, if you're a believer in those cycle theories, you would assume that materials and energy would have a really robust period of outperformance before the entire stock market goes into a bear market. Some of you will recall 2007, we had a significant outperformance of oil stocks right before the whole stock market started to implode upon itself. So keep those things in the back of your mind. Remember, every stock market's different, but we can learn cues from previous experiences within the market itself. So again, I'm going to reiterate, just because we have a bearish posture on these different indices does not necessarily mean we go into a full-fledged bear market. We could easily reestablish some sort of a bullish hold for the rest of the year. It wouldn't be entirely surprising at all. But for right now, it's more of a cautionary tone. And you'll notice that as we look at these various charts here, the top two also have red moving averages. Now, this is a 30-day moving average. Each one of these charts is 3 months in length. So the 30-day moving average is red here on the S&P 500 and also on the Dow Jones Industrial Average, meaning that price is below a falling moving average. Notice that on the NASDAQ down below here and also on the Russell 2000, we have yellow tails. And no, I'm not talking about tuna here. I'm talking about the fact that we have mixed signals. If the tail was green, it would have meant that price was above a rising moving average. But this yellow/yield sign or cautionary sign is basically telling us we have kind of a difference of opinion. Prices are down below the 30-day moving average. The moving average itself is continuing to trend up. So those are telling you two separate things. Whereas up above with the red, they're kind of in unison with one another. Price is going lower and so are the moving averages. But with the small caps and the tech, we still have kind of this mini divergence kind of an atmosphere going on. Today was real interesting from the NASDAQ perspective, down 3% today after basically being up 3% yesterday. So again, understanding of how risk enters into the various markets. Remember, the NASDAQ is still a tech-heavy index. It has diversified away from that completely the way it was back in the dot-com bubble, but if you were still to break it down and look at what's in the NASDAQ, it's still led by a lot of technology companies. These days, you do have some stocks like, I don't know, biotech companies. You have stocks like Fastenal, which is an industrial distributor. So there are some stocks in the NASDAQ these days that aren't tech heavy, but if you're thinking in generalizations in your head, think of that tech sector as still being driven mostly by the technology sector itself. And it was whacked today, nearly 3%. And you can see that's by far and away the worst performer amongst these four. The other three were down basically 2% or less. So with the NASDAQ down almost 3%, that is a tremendous amount of relative underperformance on a one-day basis. And again, it all comes back down to, what was going on there with NVIDIA, of course, the follow-through weakness with Facebook carrying on over to Twitter and some of these other social media platforms. So little bit wary now of technology, a little bit more so than we had been in the past. Remember, technology was one of the best areas of the market in 2017. So maybe we're starting to see some of these legitimate rotations now. Let's go over here to our next chart, which will be the 3 green arrows chart, or in this case, the 3 red arrows chart. When you see pink backgrounds on this particular chart setup, basically means you've got 3 red arrows. And the 3 technical indicators that we're looking at for that particular setup are going to be the 30-day moving average, and you can see we got a red arrow as just one example on the S&P 500 right there. We've got another red arrow down below on the MACD histogram, and that occurs whenever it crosses below that 0 line. And then we've got a red arrow down below here on the stochastics. In fact, the stochastics on the S&P 500 now in the lower reversal zone for the first time since February. No surprise there. We were in quite some turmoil in February as well. But keep in mind, if you don't believe that we're going to be in some sort of a true bear market, this might be an opportunity, right? If you had to look at this chart up here and say, well, where would you have you wanted to buy stocks in the past? Many of you would say, I'd prefer to buy stocks when they're on sale. It's natural. Well, coming back to February, that would have been the case. One other thing I'll share with you now that it's on my mind, give me a moment here. I'm going to pop on over to Twitter for just a brief moment. And again, make sure you're following me at Brandon Van Zee, all one word. And again, our pinned tweet is typically the Market Outlook tweet. So if you can come down here, click like, that heart sign, plus the retweet button right there with the little arrows chasing each other around, that would be great. I am generally shooting for at least 100 likes. If we got 120 like we did last Thursday, I got no problems doing these videos at all. So keep up the great effort on your end. We'll keep up the effort on making these videos for you. But the point I wanted to make is this. Let me. It might take me just a second to go find the graphic that I wanted to highlight. There it is. Over the weekend, I was going through some analysis and data like I typically do, and one of the things I like to track are new highs. And one of the things I noticed last week, and for some reason this doesn't want to zoom in very well for me, so I wonder if I can do this. It kind of blocks it. I wish I had. Okay, that's a little bit better right there. This is just a miniature screenshot that I took here, but the point I was trying to make is that in the S&P 500, there were only 13 stocks out of 500. That's a very small percentage, right? 13 out of 500 that hit new 52-week highs in the previous trading week. Now, typically what I found from my research is that if we have 20 or less new highs in the S&P 500, that's generally a time to be a buyer of stocks. Now, it's possible this is the time we go into a bear market. But what do we know factually? We know that we've been scared out of our wits many times in the last 9 years, whether it's Ebola, whether it's Zika, whether it's Trump getting elected president, you name it, Brexit. Whatever the disaster du jour is, we get scared at that moment in time. But somebody that had a cool level head could look back right now in hindsight and say, yeah, those times where we were the most scared would have been the best times to be buying stocks. And so I'll point that out again. This doesn't predict anything about the future, just merely letting you know that we have less than 20 new highs in the S&P 500 over the previous week. So it could be an interesting time to start looking at some bullish trades on extreme oversold conditions. And if you like that sort of material, again, I would encourage you to follow both myself and David Settle on Twitter, where we generally will be more than willing to share our thoughts and analysis with our viewers. All right, so that's your 3 green arrows, in this case 3 red arrows across the board with all of those major indices. Let's now take a peek at our longer term view here. It's the same 4 indices, but the difference in this particular chart is that we go back 3 years here as opposed to 3 months. Every one of these candles is 1 week in length rather than 1 day in length. And what we're looking for here are crossovers of the moving averages themselves. Now, a couple things to report here. Notice that on the S&P 500, in fact, let me right-click and go to maximize sell so you guys can see this a little bit better. Notice that price action is now touching this black line. Now, that black line represents the 40-period exponential moving average. Since we're applying it to weekly candle charts, those of you that are more familiar with daily candle charts, if you want to think of it in terms of the 200-day moving average, it's basically the same thing, since there are 5 trading days in every week. So we do have a market that is now touching its 200-day moving average, both last week and even here so far this week. But what we're looking for are the moving averages crossing themselves. It's not that the price is crossing below the black line. What we're looking for with this chart setup is that this orange line up here that represents the 10-period exponential moving average, or the gold line, however you want to describe that. We're looking for that to cross below that black line there before we get aggressive with our trades here. Remember, this is not a setup where we're assuming we're going to get out at the top or in at the bottom. We're happy to capture the big juicy part of that bone right there in the middle of the trend itself. So be on the lookout for that. We now have this gold line falling far enough where it's within the realm of possibility that we do actually get a crossover at some point if markets continue to stay a little bit beat up here. And remember, that's somewhat rare. The last time we had a crossover was 2 years ago. So this is not some sort of everyday occurrence we're dealing with here. And both the S&P 500 and the Dow Jones Industrial Average, in fact, all of them really have a pullback in that 10-period moving average there. So we need to be kind of on a heightened sense of alert right now compared to when we normally are looking at these longer-term charts. All right, let's go ahead and do some more analysis here. And this will be our Sector 12 grid. And for this, I got to kill that camera feed so that way you guys can see every square inch of my screen here, and that way you can see all 12 of these charts. Now, the way that you're going to read this is that in the upper left, we've got our S&P 500, the index itself, followed by the 11 different sectors that make up the S&P 500. And you can see that's probably what's standing out to you is that there are two and only two charts here that are green, telling us that energy stocks, which are right up here, and also utility stocks, which are at the bottom down here, are the only two that have a bullish posture using the market forecast indicator. Both the charts look reasonably interesting, but I would say of the two, the utilities chart actually looks kind of good. You know, hard to say that when we have a market that feels like it's just getting clobbered right now. But I mean, if I right click and go to utilities right here, it's not a bad looking chart right there. It's a chart where people were feeling pretty ugly about utilities for the longest time, especially right back here, the end of January, as interest rates seemed like they would never come back down again. But things change. And remember, when markets get chaotic, the assumption is that the Fed will not be as aggressive with raising interest rates as they would otherwise. And so if the assumption is not as strong that interest rates will be raised as many times as what was currently predicted, or previously predicted, I should say, then what you find is that interest rates will sometimes come down. And I don't know that to be a fact today because I haven't actually looked at that. I was busy dealing with a few other things. I was hanging out with some of you guys earlier today, but let's just take a quick peek here. And indeed, that was the case. Look at TNX. If I pull this up here on the chart, the 10-year Treasury yield was down here today pretty significantly. In fact, we're breaking some support levels here, giving us at least the hint or the glimmer of hope that interest rates will start going lower. So that then goes back to this idea of XLU makes sense. Okay, that thing is going up now. Utility stocks are becoming more interesting to potential buyers if interest rates are heading lower like they have been here in the last week or so. So keep your eye on utilities. It's not always the most fun sector to trade, I'll grant you that, but this is a pretty stable looking chart right here, and it looks like it wants to bounce off of that rising 30-day moving average, and again, that's why that tip of that moving average itself is green. So keep your eye on utilities. The other thing that I would point out is that the consumer staples have been blasted here. Some of you have heard me say in a couple of other venues in the last week that the consumer staples are getting to the point where it feels like I'm a kid in the candy store. There's a lot of opportunities out there, especially if you're a dividend-driven long-term investor, the way that I typically handle my investing accounts. And so notice that we've got cluster after cluster after cluster after cluster within the consumer staples itself. To see that better, I'm going to right click, maximize sell, and you can see that these green dots down below represent times when we've got market forecast clusters. In this case, we've got what's called an oversold cluster. Some of you might refer to those as bullish clusters, with the expectation we might get a bounce back. Now, we haven't seen a big bounce back yet, but if we get more days like today, the environment starts to change where money that was once chasing the next hot cyclical sector starts to revert and go back towards the more defensive risk-off areas of the market. We're already seeing a glimmer of that with utilities. It's not, out of the realm of possibility that we start seeing some money drifting towards the staples again as well. They've got their own set of problems, but it's certainly to a point where things have gotten pretty extreme. And for those of you that are, looking for maybe a reversion to the mean type of a trade, we'll review one such idea here a little bit later in today's video. Let's go ahead and before we do that, go over here to our next 12 grid, which will be this foreign markets 12 grid. And in this case, we've only got one lone holdout from the bullish perspective, and that's Mexico. So go figure. The company that is the country that is most targeted with the whole talk about building a wall and all that kind of stuff. Well, that's the only one right now that's actually holding up reasonably well from a stock market perspective. All the other foreign charts here that we're looking at do give us bearish market forecast postures using that intermediate term line. And I wouldn't go on record saying Mexico's chart looks great. It's just merely holding up better in the extreme pullback days that we've had here recently. It's kind of holding the line right around that flattening moving average right there. And then let's take a look at our intermarket analysis 12 grid while we're at it. And here we've got more of a mixed bag. And again, I'll always remind you guys that that was by design. I wanted to set up this third set of 12 grids so that way we could look at some things that could potentially be bullish even if the stock market itself was bearish. Like it somewhat is right now. Remember that some of these charts that we're looking at on this third set of 12 grids here will represent things that have nothing to do with the stock market, like commodities or bonds or what have you. So as I look at these various charts, first of all, no surprise, the VIX was up today. It was up 7%. If anything, I would have probably anticipated the VIX being up more than 7%. So if there was any surprise there, it's maybe that it wasn't up more. But indeed, it was up today, and that's what you would expect. Remember, the VIX is known as the fear index, and it usually works inversely from the stock market itself. As far as looking for trends, the only stock chart that looks mildly interesting from a trend perspective, and it's not even a stock chart, I should change my language there, but it's this chart in the middle. It's a bond ETF chart. Let me right-click on it and go to Maximize Sell. And the ticker symbol for this particular one is BWX. And so BWX represents foreign bonds. And again, you probably aren't going to get overly excited in the morning to wake up and trade foreign bonds any more than you're going to get excited about trading utilities. But remember, you gotta take what the market's giving you. And there will be times where the market doesn't want to give you much of anything when it comes to cyclical areas of the market. And there are times where you need to batten down the hatches and just kind of cool out for a little bit. And, bonds are traditionally a place where money will drift when the stock market itself gets chaotic. Not all the time. They're not attached at the hip or anything like that, but you will find that can oftentimes be the case. So right now, you look at BWX, it looks reasonably interesting here for kind of more of a safety type of a trade in the meantime while we're waiting for the market to kind of start stabilizing a little bit more. So that's your 12 grid analysis there. Let's now get into our trade application idea for the day. And what I want to do is pull up a chart of Pepsi. Now, I mentioned in the intro that today's trade application idea would come from a stock that was able to actually buck the overall market trend today. It was up. It wasn't up a lot, but it was up 0.78% today, or 83 cents, however you want to look at that. Pepsi is obviously well-known worldwide. It needs no introduction. It is a dividend aristocrat, by the way. A lot of times people think of Coca-Cola from that perspective, but both Pepsi and Coca-Cola are dividend aristocrats, meaning that they've raised their dividends every year for more than 25 years in a row or more. So that then leads me to what I was also hinting at in the intro today, which is this stock has a yield currently that is more than what most people assume that it is. Let me explain. I'm going to come over here to the trade tab, and I want to pull up Pepsi on the trade tab right here. And I want to show you that the yield on Thinkorswim shows 2.99% with this stock currently at about 107.64. Well, that's fine and dandy, but the reality is in my own head, I already think of Pepsi as having a higher yield than that. So if you're wondering why, the reason is hidden within press releases. And this is not an easy one to find, so I had to kind of look for it before I recorded this video. Go back to February 13th, and on February 13th, there is a couple different articles out there that day because they were reporting earnings and different things like that. But I'm going to click on this one right here, and it says PepsiCo raises annual dividend from $3.22 to $3.71 per share, effective with the June dividend. So Pepsi is a little bit strange in that when they announce a dividend increase, they announce it for a couple of quarters later. Nearly all other companies that I follow, when they announce a dividend increase, it represents their very next quarterly payment. So the issue with that is the financial websites aren't necessarily doing anything wrong, or in this case, Thinkorswim isn't necessarily doing anything wrong by showing a yield of 2.99, because for this current quarter, that is accurate. But remember, dividend investors are already readjusting their expectations. So in my mind, as a dividend investor, that is no longer the true yield. The true yield is wherever that new rate is going to be going forward, and investors should adjust themselves accordingly. And so notice that the dividend back here on the Thinkorswim platform shows 80.5 cents. Let me get my calculator out here. And I want to show you that 80.5 cents times 4 to annualize that quarterly dividend is $3.22. So when you look at this headline in the news story back from February, it says $3.22 to $3.71. So they already did the hard work there for us and annualized that dividend amount at the new rate effective in June. So the point I'm trying to make, if I come over here to my calculator and type in 3.71 and then divide that by the current price, again, right up here, 107.64, we're looking at a true yield of 3.45% effectively if we round up. 3.45%, and not 3% yield, 3.45%. That's significantly more. That's like a 15% increase in dividend right there that most investors don't know is actually the case right now because the financial websites are not showing the new rate for the June quarter. One other thing I will point out, well, first of all, since we're on this chart, notice that we did have a bullish cluster. Another way to phrase that is an oversold cluster. So we had all these down days in a row, resulting in a bullish cluster. So it's possible we start getting a reversion to the mean after that. In addition to that, if I take a look at what I call my dividend stair-step chart here, I'm going to pull up Pepsi, and you'll notice that it's hanging out right at this gray line. Again, the gray line is going to represent a 3% yield, but that 3% yield isn't actually accurate. And that's, again, just a function of the peculiar nature of Pepsi announcing their dividend increase a couple quarters in advance. So the true yield, notice that these dividend stair-step charts will go up every time they raise that dividend. Well, it hasn't gone up here recently because the financial websites haven't accounted for that 15% increase. When it does, these lines will readjust. And remember what I just got done saying on that calculator, that its true yield right now is 3.45%. Well, this stock generally does well. You'll notice up here in this label it says average high yield 3.21%. It usually starts finding some stability and some buyers when it has a 3.2% yield. So it's got a 3.45% yield effectively right now. So soon enough, these lines will jut higher after we get through the current quarter, and this thing will basically be sitting at or below the green line. And you can just use your eyes to eyeball this. Usually in the past, when Pepsi touches that green line like it did right there, like it did back here, almost did right there, and back in the financial crisis, that's generally a time for long-term investors to be considering picking up shares in a high quality company. So a lot kind of going on there. Some of you are following that. Others maybe less so, depending on how much experience you have with dividend investing. But the long story short is this is kind of a hidden gem situation right now where a lot of people do not assume that Pepsi actually does have a 3.45% yield. So what we're going to do here today is just simply sell a put on Pepsi. And what I'm going to do is I'm going to come out here to April. This is the monthly contracts with 24 days until expiration. Let's pull up a few more strikes here. And I'm going to actually change this to a Delta Gamma Theta Vega as well to get a little bit more information regarding the Greeks here. And you'll notice that our 30 delta, which is a delta that a lot of people typically will target as a starting point when they're selling puts and selling put spreads and different things like that, that will bring us to our 105 strike. The other thing I'd point out is that the last I checked, Pepsi was supposed to report earnings after the April expiration period. So for some of you, that's important as well, where you're not going to be holding a sold put through a expiration period. So what we're going to do is we're going to sell the 105 put. We'll try to get, let's call it, I don't know, 95 cents or so for it, maybe 96. Somewhere in between the bid and the ask is what I want to shoot for, which is currently showing us a bid-ask spread of 94 cents by 101. So it's approximately $1. In other words, if you end up getting put this security, your break-even price is effectively around $104 as opposed to the 107 it's trading for right now, which means that your starting yield on cost is even greater than 3.45 if that does shake out. On the other hand, if Pepsi bounces from here, you keep that dollar, no harm, no foul. So with that, I'm going to go ahead and just click the bid price right here. And I am going to change this to just one contract. I'm not going to get overboard. This is a $100 stock, so you got to have about 10 grand set aside in order to pay for this if you want to do it on a cash secured basis. And I am going to try to get, like I said, let's try to get 97 cents out of that. And this one I'm going to do a little different. I'm comfortable getting this not tomorrow, but the next day or the day after that, I'm going to change it to a good till cancel. A lot of times I'll leave that day order only, but in this one, I'm kind of intrigued by this one. So I'm going to put this in as a good till cancel. Hopefully we get filled first thing in the morning, but if we don't, that will be available for follow-up days there as well. So confirm and send. And we'll ship that off, and we'll see how we do with that Pepsi trade there. So with that, we'll end our video here tonight. Another wild ride on Wall Street. Hope you guys aren't getting too seasick out there. But as we highlighted here with Pepsi, there were few areas, especially the defensive areas of the market, that were able to withstand the storm here today. So let's keep our eyes on that situation and see if the market is drifting more and more towards those defensive areas, and then start adjusting accordingly with our various trades that we have out there. So with that, I want to thank you for tuning in here tonight. David will be back with you tomorrow, and then I'll plan on being back with you on Thursday, and I'll look forward to that. So with that, all the best with your trades and your investments. Goodbye for now.